In America's financial world, the story being written right now is nothing short of a thriller movie. Because over the last 48 hours, the biggest banks on Wall Street made a mistake so large that they may end up paying for it all year long. And this story begins in the final days of the year, at the exact moment when most people are distracted with holiday plans and New Year celebrations, when America's most powerful banks quietly launched a secret and extremely aggressive mission. Their objective was crystal clear: to crush the price of silver before the year-end close, to trigger stop losses, to break the morale of the bulls, and to prove that they still control the market. And for a few hours, it looked like they had won. Silver collapsed rapidly and fell all the way to $70.50. The charts made it look like the entire rally was finished, like this was just another failed commodity story. Fear spread across social media. Retail traders panicked. YouTube filled with thumbnails screaming, "Silver crash." But right at that moment, the script changed, because the one thing the banks were counting on, panic selling, never arrived. Suddenly the selling stopped. The price refused to go any lower. And as America entered the final hours of 2025, silver climbed back to $71.83. A clear doji candle printed on the daily chart. And in technical analysis, a doji tells only one story. Selling pressure has been exhausted. This is not just indecision. This is fatigue. This is proof that the market absorbed everything the banks threw at it. And this is where the biggest mistake was made, because by smashing the price, they did not kill the rally. Instead, they unknowingly created the greatest buying opportunity in history for their competitors. They made silver cheaper for China. They made silver cheaper for Samsung. They made silver cheaper for every industrial and sovereign buyer that is already draining the vaults. And now, as we go deeper into this analysis, the truth becomes clear. The drop to $70 was not driven by weak fundamentals. It was a regulatory flush, an end-of-year accounting event. And the biggest evidence is the floor where the market stopped, $70. This was the breakout level from weeks ago, the ceiling that held prices down for months. And when the crash happened, the price went straight to $70.50 and slammed into a concrete wall. It didn't go to $68. It didn't go to $65. It didn't go to $60. It stopped cold. And that tells us something critical. There is a strategic bid sitting at $70, buyers with automated orders, industrial buyers, sovereign buyers, entities that do not buy on fear but on value. The banks tried to create panic, but instead they found liquidity. They sold cheap silver into strong hands. Ownership transferred from paper speculators to physical accumulators. And for a short seller, this is a fatal error, because you want to cover shorts from weak hands, not sell to strong hands. Strong hands do not sell it back. They remove the metal from the exchange, they melt it, they lock it away in vaults, and by driving the price to $70, the banks accelerated the drain of physical inventory. They made silver cheaper for the entire world. Now, if we look at the volume profile of the recovery, the picture becomes even clearer. Price has rebounded nearly $1.50. The chart shows a long lower wick, and in technical terms, a long lower wick is rejection. The market went down, looked at the lower price, and said no, too cheap. And this rejection happened on the final day of the year, which makes it critical, because despite tax selling, despite G-SIB liquidity pressure, despite everything, the market wants to close the year above $70. This preserves the bullish structure on the monthly and yearly charts. No fatal damage was done. This was a flesh wound, not a broken bone. And now we come to the real cause: G-SIB surcharges. The boring but powerful regulatory reason behind the entire move. Global systemically important banks are scored at year-end based on a snapshot of their balance sheets. And if that score is too high, they are forced to pay billions in additional capital requirements next year. So every December, these banks sell assets, close derivative positions, and pretend to be smaller than they really are. They are not selling silver because they believe silver is going down. They are selling silver because they need to look cash-heavy and asset-light. This is a regulatory illusion, but it has an expiration date. Midnight on December 31st, once the calendar flips, that pressure disappears and the market returns to supply and demand. This is why the drop to $70 was a bear trap. It lured retail traders into selling the bottom. But in reality, this was an accounting maneuver, and anyone who sold yesterday got played by JP Morgan's accounting department. And when we look at the Shanghai data, the case becomes airtight. New York crashed to $70. Shanghai also dropped, but the spread remains nearly $4. China is still paying more for silver than the United States. The arbitrage gap did not close, and that means metal is still flowing from west to east. Paper prices can be smashed. Physical reality cannot. And as long as China is willing to pay $75, silver in America cannot go to $60. This floor is solid, and this is the mistake that changed everything. As the new year begins, the story takes an entirely new turn, because, as the first 48 hours of 2026 open, the same banks that were desperately covering shorts just days ago are now exhausted and in damage control mode. And into that vacuum steps a new giant. The American pension funds, endowments, and institutional allocators. This is capital that does not make noise, does not trend on Twitter, but when it moves, it reshapes markets. The January effect is no longer theory. It is a mechanical process. The year is closed, the data is final, and the 2025 leaderboard is clear. And at the very top sits silver. It outperformed the S&P 500. It beat bonds. It beat real estate. And when these funds return to their offices on Friday morning, the first question they ask is simple. Do we own this asset? And almost everywhere the answer is no. And that is where the great rebalancing begins. Trillions of dollars in passive capital slowly rotate out of overvalued tech stocks, out of losing bonds, and into the asset that delivered alpha. And this buying is fundamentally different from bank buying. Banks buy to neutralize risk. Pension funds buy to build positions. They remove supply from the market and lock it away in vaults for a decade. And when bank short covering collides with institutional long accumulation, price action becomes violent and vertical. This 1-2 punch is what sends markets into runaway moves. And when we look at the yearly chart, the message becomes undeniable. 2025 closed with a massive green candle, nearly a marubozu, opening near the lows and closing near the highs. In technical analysis, this is one of the most powerful signals that exists. It tells algorithms that the long-term trend has shifted, and those algorithms control sovereign wealth funds and global capital pools. They move slowly, but when they move for years, and now a new program has been loaded for 2026. Buy silver, and at the same time the physical market tells its own story. Paper prices have rebounded, but dealer premiums have not collapsed, and inventory has not returned. Normally rising prices bring sellers back, but this time the opposite is happening. Even at $75, people are buying. Secondary supply is broken. Silver is being hoarded because one number is now embedded in public psychology. $100. And when the public refuses to sell, the miners refuse to sell, and banks are forced to buy. There is only one solution. Price must rise high enough to break hoarder psychology. $75 didn't do it? Maybe $100 will. And this brings us to the miners. Mining stocks were crushed yesterday, but today they are flying. Investors are realizing that $75 silver is a cash flow bonanza for producers. Companies like Hecla, Coeur, and Kerr are generating 20 to 30% free cash flow yields at these prices. Yet mining stocks are still undervalued relative to the metal. Historically, when silver makes new highs, miners should be at all-time highs as well. But they are